Imagine a world without credit cards, without digital transfers, without even the secure movement of cash. This was medieval Europe, a continent riddled with danger, where carrying a purse of coins could cost you your life. Yet, amidst the chaos of bandit-infested roads and warring kingdoms, a revolutionary idea was slowly taking root. A trick was about to emerge from the shadows of merchant guilds and moneylenders, a clandestine innovation that would not only transform how wealth was moved and stored, but would lay the very bedrock of our global financial system. This is the story of how medieval ingenuity birthed modern banking. In medieval Europe, wealth was tangible: gold, silver, and copper coins. But this physical prosperity came with immense risks. Traveling merchants faced highwaymen, pirates, and even corrupt officials eager to relieve them of their heavy coin pouches. Furthermore, the value of coins varied wildly, often debased by rulers. Moving large sums across borders was a logistical nightmare and an open invitation to disaster. The need for a safer, more efficient method of transferring value was not just a convenience. It was a desperate necessity for the burgeoning trade networks of the age. From this crucible of risk emerged the money changers. Huddled over wooden bancos, benches, in bustling marketplaces, these shrewd individuals became the arbiters of wealth. They meticulously weighed and assessed foreign coins, converting them into local currency for a fee. But their role soon expanded. Merchants began depositing their coin with trusted money changers for safekeeping, receiving a written receipt in return. This simple act of deposit marked the nascent stages of banking, transforming the money changer from a mere currency broker into a guardian of wealth, laying the groundwork for a far more complex system. The true innovation, however, was the bill of exchange. Instead of physically transporting coin, a merchant could now deposit money with a money changer in, say, Florence, and receive a bill, essentially a written promise, to be paid a specific sum by a corresponding money changer in another city, like Bruges. This paper transaction eliminated the dangers of travel and the cumbersome weight of gold. It was a leap of faith, an intricate dance of trust across vast distances, enabling commerce to flow more freely and securely than ever before. This wasn't just paper, it was a revolution in economic trust. For the bill of exchange to work, a sophisticated network of trusted money changers was essential. These were often family businesses, religious orders like the Knights Templar, or merchant guilds with established connections across Europe. They acted as intermediaries, vouching for each other's solvency and integrity. This intricate web of relationships, bound by reputation and mutual benefit, formed the invisible infrastructure of medieval finance. Trust was the ultimate currency, allowing wealth to flow across borders without ever physically moving, a testament to early globalization and the power of human connection and commerce. No family epitomized this new financial power more than the Medici of Florence. Beginning as modest wool merchants, they diversified into banking, leveraging their widespread connections. The Medici Bank wasn't just a local establishment. It had branches across Europe, from London to Lyon. Their sophisticated use of bills of exchange, letters of credit, and complex accounting allowed them to fund popes, kings, and grand artistic endeavors, effectively becoming the central bank of their era. Their influence wasn't just economic. It shaped politics, art, and the very fabric of the Renaissance, demonstrating the immense power of financial acumen. But the true trick lay deeper, a subtle yet profound shift in how money itself was perceived. Bankers noticed that not all depositors came to withdraw their funds at the same time. A significant portion of their deposits always remained in the vaults. This realization sparked an audacious idea. Why let this idle wealth seek? Bankers began lending out a fraction of the deposited money, charging interest on these loans. This practice, known as fractional reserve banking, meant that the bank now had more claims on money than it physically possessed, an invisible expansion of the money supply, seemingly out of thin air. This trick was, in essence, an act of financial alchemy. By lending out a portion of deposits, bankers weren't just moving existing money. They were creating credit. A borrower received a loan, which they then spent depositing it into another bank, which in turn could lend out a fraction of that new deposit, and so on. This multiplier effect meant that the total money circulating in the economy far exceeded the physical gold and silver in the vaults. It was the birth of credit, a revolutionary concept that unlocked enormous economic potential, fueling expansion and growth on an unprecedented scale. With this newfound ability to generate credit, medieval bankers became indispensable to the powerful. Kings, popes, and merchants could now borrow vast sums to finance ambitious projects. Crusades, once limited by the physical gold available, could now be funded by loans. Grand cathedrals, expansive trade routes, and even early industrial ventures became possible. This trick didn't just facilitate commerce. It transformed the geopolitical landscape, allowing states and institutions to undertake endeavors of scale and ambition previously unimaginable, demonstrating the direct link between financial innovation and global power. As banking evolved, so too did its instruments. Bills of exchange became more standardized, even transferable, laying the groundwork for negotiable instruments. Letters of credit grew more sophisticated, acting as early forms of travelers' checks. These pieces of paper, backed by the reputation of the banking houses, began to represent wealth more effectively than the heavy, vulnerable coins they replaced. The power shifted from the inherent value of metal to the abstract promise of payment, a conceptual leap that would forever change how humanity perceived and managed its prosperity, paving the way for modern paper currency. However, this powerful trick was not without its shadows. The fractional reserve system, while incredibly potent, carried inherent risks. If too many depositors demanded their money back simultaneously, a bank run, the bank, having lent out a portion of its reserves, would be unable to pay everyone, leading to collapse. Trust, therefore, became paramount. A whiff of rumor, a failed harvest, or a war could trigger widespread panic and financial ruin, causing a ripple effect throughout the interconnected European economy. These early crises were stark lessons in the fragility of credit. The informal bancos of money changers gradually gave way to more formalized institutions, the great banking houses. These were often family-owned, but their scale and complexity demanded sophisticated organization. They developed internal structures, specialized roles, and robust record-keeping. The shift from individual enterprise to institutionalized banking brought greater stability and expanded capabilities. These early banking houses, with their specialized skills in finance, trade, and even diplomacy, became central pillars of their communities, proving that the trick could be scaled and managed with careful oversight and innovative practices. Lending money at interest, known as usury, was largely condemned by the Church as sinful throughout much of the medieval period. This posed a significant moral and practical challenge to the burgeoning banking industry. Bankers often circumvented these restrictions by charging fees for currency exchange, disguised interest rates within complex contracts, or structuring loans as investments. This constant tension between religious doctrine and economic necessity forced ingenuity, leading to the development of sophisticated financial instruments designed to obscure the true nature of interest, highlighting the complex relationship between finance and morality. A crucial, often unsung, innovation that undergirded the success of complex banking was double-entry bookkeeping. Popularized by Luca Pacioli in the late 15th century, this system recorded every financial transaction with both a debit and a credit, ensuring balance and accuracy. It allowed bankers to track multiple accounts, monitor profits and losses, and manage the intricate web of loans and deposits with unprecedented precision. This systematic approach to accounting was vital for the transparency and accountability required to manage fractional reserves and vast sums of credit, turning financial chaos into organized data. Venice, the queen of the Adriatic, became a crucible of financial innovation. As a maritime republic deeply entwined with international trade, Venice pioneered many banking practices, including state-backed banks and the concept of public debt. The Venetian government itself issued loans to fund its navy and trade expeditions, selling transferable shares to citizens. This established an early form of a public market for debt and investment, further blurring the lines between private banking and state finance. Venice's financial sophistication cemented its place as a dominant economic power, showcasing how banking could serve national ambition. The medieval trick of fractional reserve banking and the innovations surrounding it are not mere historical footnotes. They are the bedrock of our modern financial system. Every time you deposit money, take out a loan, or use a credit card, you are engaging with principles first honed by medieval money changers. The global economy, driven by credit and abstract wealth, stands on the shoulders of these ancient pioneers. Their audacious realization that wealth could be generated not just from existing assets, but from trust and the promise of future payment, irrevocably changed the course of human economic history. From the bustling medieval marketplaces to the soaring towers of global finance, the echo of that ancient trick reverberates. The audacious realization that not all gold needs to stay in the vault, that trust and a promise on paper could generate wealth, forged the very mechanisms that power our world today. So the next time you use a credit card or see a news report about interest rates, remember the shrewd medieval bankers. They didn't just move money, they created it, laying an invisible foundation that continues to shape our present and future, a testament to the enduring power of human ingenuity.